Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you joined us for our next live presentation from Xmachina AI Group. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Claude Thierry, Chief Executive Officer, and Patrick Brown, Chief Financial Officer of Xmachina AI. Welcome, Claude and Patrick.
Thank you.
Thank you, Cecilia. Hello, everyone. Here at Xmachina, we are building the Roper or Constellation software of AI. The idea is that we will acquire and are acquiring revenue positive AI companies. We've already met, we were tracking 1,124 companies. We've met 340, and we've gone and had further meetings with 99 companies. We have one SPA that we're going to present to you today and one LOI, with the goal of being one of the few AI companies listed on the Canadian Stock Exchange with strong profits within the first year. Xmachina is a de-risked AI investing strategy. The goal here is to acquire 25 companies in the next 3 years and to build up $100 million in revenues with $18 million of free-flowing cash. The investment criteria that we're looking at is that we're trying to acquire companies that have a minimum of $2.5 million in revenue, profitable or break even, minimum 20% growth rate, which is very important because the overall portfolio will have a 20% growth rate year over year, which means doubling revenues in 5 years. We acquire VC-backed companies or bootstrapped, and we're looking at companies that do boring AI. We want companies that do low liability risk, low regulatory risk. So we're looking at logistics and scale and supply chain, small business manufacturing, prop tech, entertainment, and mining sectors right now. We're kind of staying away from anything where there's strong liability issues with AI, so self-driving cars, medical, and fintech. We're also going to acquire peripheral data companies, so anything that fits into the data value chain of AI, including ML ops, data labeling companies, anything that can be used to create AI. We are looking for companies that already have product market fit. We're not investing heavily into R&D. We want companies that that's where we're putting the $2.5 million minimum hurdle. We want companies that are not just accumulating logos and proof of concepts. We want companies that have already passed procurement and are in production with the various clients they have. We've met 99 companies now so far. Here, the goal is that once we look under the hood of a lot of AI companies today, we actually realize a lot of them are not doing that much AI. Also, a lot of them are not, the financials aren't just quite there. The way to think about this is that if you're not sure about your AI investing strategy, if you don't have the team to do the due diligence of all these AI companies, we are building a de-risked AI portfolio for normal investors. So this is great for retail investors. This is great for small institutional investors. It's de-risked because we're doing all the heavy lifting and all the hard work of screening companies. When we acquire companies, we're actually doing it in a very cash efficient way. Okay, the deal structures is such that we're offering 1 to 3x revenues. So as a multiple on service revenues before due diligence, the deal structure is the same for everyone. We're offering 1x non-recurring revenue, and we're offering 3x on recurring revenue. Of course, upon due diligence, we do a quality of revenues test, these ratios can go down. But the deal structure is the same for everyone. And the idea here is that we're creating an arbitrage opportunity. Currently, right now, the VC market, as we know, is traversing a very difficult time. After 2021, we've seen valuations in the public markets of SaaS companies fall almost a factor of 6. The current VC industry is willing to sell a lot of these AI companies. As you may know or you may not know, AI companies always have strong service components. They don't scale as quickly as pure play SaaS. A lot of VCs who have to return capital in the next 3 to 5 years will want to offload these companies from their portfolios. We are there. We are already in discussions with VCs across the US and Canada who are very happy to sell us their companies for pennies on the dollar. What we're creating here is actually, in one sentence, is we're creating an arbitrage opportunity of a new asset class which is basically AI companies, and the arbitrage opportunities between publicly held and privately held AI companies. We acquire for 1x, and we are immediately valued at 2.5x. So if you're a public markets person, you will understand this. One of the reasons why right now is that the simple fact that these companies become liquid makes them much more valuable. So here's the index that we looked at. These are all companies that are listed in Canadian Stock Exchange that are doing AI services. They have actually a 2.1 revenue multiple. It's actually 2.5 now. The market's bounced back a bit. And if you look at purely recurring SaaS companies, the market right now, the bottom of the market, it's a 7x upon recurring revenue. So what we're doing is we're acquiring for 1x, and we are being valued upon that at 2.5. And of course, we're on recurring revenue, we're acquiring at 3x, and we're being valued at 7x. Now, the idea here is that we are currently raising to list. We're a near-term listing opportunity. I'll let Patrick speak about that.
Yeah, no, it's hopefully
Patrick?
weeks away before we file our final non-offering prospectus with the Canadian Stock Exchange, followed thereby with a co-listing on the OTC. We have been building our structure and our acquisition funnel for the past year. And I think one of the bigger questions we get regularly is, why would somebody who's got a profitable AI company want to sell? And the answers are, for us and for them, it's a liquidity issue. They've spent usually half a dozen years or so building their model, refining it, building the revenue pipeline, and they're looking for ways to take a little bit off the table, but as well as work with a team that can help them achieve their next goals. So we enable them. We don't consume them. We let them operate as solely independent, 100% owned subsidiaries. We refine them. We make them a bit more profitable by taking out their back end and help them with their deal flow or sales funnels. So, yeah, looking forward to a robust listing. I think we've created an opportunity whereby the risk of guessing which AI company is going to be the next best of breed is what we're dealing with. So we've done the homework. And our job is then to present a refined package of opportunities. And listen, at the end of the day, if one of our acquirees becomes, for lack of a better term, a unicorn, we are able to spin that off if it requires a life of its own. And then, of course, we get the trailing leave behind for the shareholders of our group.
So, as Patrick mentioned, we do not merge these companies. Very much like Roper or like Constellation Software, we are leaving them as wholly owned entities. The only thing that we're doing is, of course, we're going to be publicly reporting. We need IFRS accounting, so we're going to centralize the accounting and reporting structure. We also have centralized sales reporting and offer sales help. One of the things that you may or may not know about AI companies is that they're often started by technical founders, and they have, most of them hit major issues when it comes down to commercialization, certainly above a certain revenue number. So when we hit those, we have the value add that we bring is that, and we'll go over the team later, is that we bring product refinement expertise. We help the company become more profitable immediately by centralizing accounting. We have quick access to capital, so we don't only acquire these companies. We are actually, when we do due diligence with the team, we're very founder friendly. We work with the team so that they're staying on for 3 years. This is not an exit for the team. We're acquiring with 25% cash down, another 25% in shares, and then it's a 3-year earnout. All these companies are a bit positive, so they can actually do some vendor financing. So we're acquiring these companies in a very cash efficient way. The other thing we have is that private companies have a lot of trouble attracting senior sales talent, because that senior sales talent wants to be paid in options, and they want those options to be liquid. So being public, again, is a major advantage to attracting senior sales talent and other terms of talent to the companies. And as we know, talent in AI is very rare and very hard to get. The bonus here is that we're not only providing sales talent, is that upon year 3, one of the things we want to do is to improve the infrastructure of AI. And we'll talk about this a little bit later. But as much of you know, right now, what is resonating and what has added a lot of value to the NASDAQ are companies like NVIDIA. AI has some very big challenges when it comes down to computational capacity. So the companies that are benefiting from AI are a little bit like the picks and shovels of the mining industry. It's the people who are providing the tools to do AI. We will, upon year 3, be able to put people on common infrastructure on the compute level that will vastly make them more profitable. Okay. So let's talk now. What I'm going to do now is just go over briefly the team. I am a former astrophysicist. I founded Canada's first, arguably one of the first AI companies. I have 2 patents in unsupervised learning, and I sold my company in 2017. I exited, became an investor. I'm in 4 venture capital funds. So I see deal flow from all those funds. And that's where the advantage of having that deal flow and seeing where VCs want to start offloading these companies, that's where that comes from. I've sold for over $10 million in AI services and products in my first startup. And then I turned around an AI company that had really a little bit of outdated AI, took it from 2 cents to 20 cents on the public markets. And then that's why we're able to raise so quickly to get this going. My co-founder on the AI side, Daniel Douet, founded the first seed VC in Canada, Real Ventures. He raised the first $50 million for Real Ventures and did 40 deals. So Daniel is excellent when it comes down to negotiating the LOIs, sitting down with the companies, and helping them grow afterwards. Von DeMarco, the youngest member of our team, has 2 deep learning startups under his belt. Went through one of Canada's best AI accelerators and was spotted by Hélène Desmarais, who's very central in the Canadian AI ecosystem. And he became an investment director of a provincial AI fund. Von did 200 due diligences of AI companies and co-invested $35 million worth of money into 50 companies. So together we are a deal flow and due diligence team. Okay, the team that a lot of like institutionals that we're speaking to don't have. We're that layer for you. Okay, and we are happy to look at some of your deals as well. We're actually having a lot of VCs and various institutionals now sending us deals and asking them to do diligence for them. We are also listing. We have a great public markets team. I'll let Patrick introduce himself and Scott.
Yeah, thanks, Claude. Yeah, on the capital market side, we are fairly well knitted together between myself and Scott Monroe, my CIO. We have just about over 100 different levels of exposure within the public markets, from building pubcos to launching to refining and creating back-end opportunities within our particular talent sphere. Classically trained CPA, 20 some odd years in the public accounting space, and ran a small microcap venture capital operation out of Houston, Texas for a number of years, and sort of learned the meaning of effective IR and how to push an opportunity within into the right audiences. So between Claude's due diligence and AI big brain group and us, I think we make a fairly decent team. I don't think there's many opportunities in the marketplace that represent the AI understanding that this particular team has. So we're pretty geared up and pretty excited about moving through our acquisition phases.
So on that note, we have two amazing companies that we're acquiring. Just one thing to put out there. Upon acquisition of these two, one of them is structured as an all-share deal, which requires no capital, although we have the option to pay up to half in cash upon acquisition. With these two deals under our belt, by end of calendar 2024, we'll have 11 million in revenue, projected revenues, with $4 million in free-flowing cash. These are very profitable companies, some of them with recurring revenue. So let me get to the first one. The first one's called Project Z. It's a revolutionary AI company that replaces test screenings in the film industry. It's actually founded by an Oscar winner who won an Oscar for a documentary film, who has a very big operation in Vancouver, produces films in the $10 to $20 million range, and developed this tool with one of the heads of products of Microsoft's AI in Seattle. The tool works perfectly. As you can see, this is a screen grab of the actual tool. It does facial recognition of people watching the film on 16 emotions real time, and then tracks those emotions to different scenes in the film. As you can see here, we can see the film is playing. Instead now of like flying people in to do a test screening at the end of the film, which is expensive, it's a time delay. Right now, what's happening is when people watch a film, a human, usually a psychologist or a focus group person, watches the facial reactions and scores it by hand. This is a major, major technological improvement. Right now, what we do here is we can stream the film through Teams, okay, or on a laptop, and people can see the film. All the data is recorded, and we can actually tell, what are the demographics that react to what's seen. And this is a very tough problem right now in the film industry. So far in 2023, first quarter alone, they booked 2.5 million in revenues with 70% margin. Let me repeat that. Okay, first quarter of 2023, 2.5 million in revenues with 70% margin. The film, not only does it record people's emotions and tracks them to the scenes, if you can see here where it says labels, it actually identifies everything in the field of view of the camera. So, yeah, as a lot of you may know, if you've watched Game of Thrones, they kept finding Starbucks cups and Starbucks paraphernalia in the various scenes of Game of Thrones. This makes sure you don't have a watch in a gladiator movie or something like this, because it'll identify everything on the screen. On the flip side, if you're doing product placement and you need a can of Coca-Cola or a cigarette being lit for a certain amount of seconds in the film, this also records this. So this is a game changer in the post-production world. And right now, it's not recurring revenue, but films tend to be produced in dockets. Patrick, do you want to talk about that?
Yeah, having spent 20 some odd years exposed to the film industry on the finance side, which was my specialty, this is kind of kind of an eye opener product, the first of its kind I've seen. And so essentially, films and film production companies that such as Project Z, they create like baskets or slates, or sign on to do slates with the majors. And what that allows them to do is have efficiencies in staging, in post production. Allows them to keep staff and crew on through a longer term without having to sort of restart the engine every time. So, to the benefit of this crew, they've got fairly significant relationships with some of the majors in California, and they are able to basically book their studio on a full-time basis. Present terms being accepted due to the strikes, but they've been busy and they continue to be busy. So the pipeline looks quite decent. It's again not recurring revenue, but there's a certainty in it because the cost of this particular benefit or asset to them is embedded in the production budget. So once it's underway, certainty of revenue is quite clear.
Secondly, we're going to work with the team. One of the reasons that the founder is selling it to us is that he wants to keep being a film producer, and he can't attract the kind of capital he needs to finish this tool, not finish it, but make it completely self-serve. So we have that. We have a very good product team. We have everything in place to take the software just up a notch on UX, where we're confident that we'll be able to sell it to the majors. He's already in discussions with Paramount and Columbia. Okay. So we're being very conservative. We're just going to assume it's growing at 20% a year. But when we were talking earlier about some of the companies that may really explode, this is definitely one of them. In case this does need a lot more capital, we're really happy to do a spinoff and make all our shareholders win, and have it raise its own capital. So we're very excited about this. It is a game changer in the film production industry. It doesn't have very much competition in the entertainment space. The other people who are doing this in the focus group space, and the software is not well adapted to the entertainment space. So we're very, very excited about this. It is now beyond the LOI stage. It is at the SPA stage, and upon listing, we can close this immediately. Anything we are currently raising a debenture to list. We've closed first $500,000 of that debenture. We're raising 1.75. So at the end of this talk, I see there's some questions already about how can I buy your stock. We'll address this right away. But anything that we oversubscribe on, we can actually pay for up to half of this company in cash as well to avoid further dilution. But we're very, very excited about this. Now, the second acquisition is actually in that hot space I mentioned earlier. What we saw is that, in 2023, NVIDIA added the market cap of Intel, of its main competitor, in a few months alone. One of the reasons this is happening, and one of the reasons why people are even looking at quantum computing, is that there are not enough chips in the world right now to train all the models that we need to train for AI. So as I said earlier, it's the picks and shovels of AI right now that are winning. It's the same analogy that people use in mining. So all the tools to use to train AI models are what is actually making cash. So this is a company founded by a founder who's 70 years old. He's moving to Costa Rica. He is done. He wants to sell us this company. This is structured as an all-cash deal, but we're very excited about this one as well. Why? Because they have a patent that changes the firmware on a normal chipset and allows a normal chipset to become a parallel processing chip. And what makes NVIDIA so important is that they're taking what we call the graphics card. So the graphic cards that you may have loved in the earlier days, if you played computer games where you needed the graphic card to do parallel processing. Well, those GPUs now at NVIDIA are selling at $40,000 per card, $40,000 per processor. That's why NVIDIA, and they're all sold out. So the potential of this company is amazing. It could take a normal computer, a normal processor, and allow you to do AI. Now, of course, it's not as good as the NVIDIA graphic cards. We're not saying that. but it saves companies so much money, right? And the beautiful thing about this is that it is recurring revenue. We put the server in. Some of you may know what edge computing is about, but this is an edge computing startup. They have solid revenues already. They're really focusing on one kind of space right now, which we love, which is fleet response. Meaning that when you want to, let's say, deploy a service vehicle for Bell Canada or something like that, you have so many parameters you need to take into account. And that is now being done by AI on these. And for Bell Canada, they have that contract. Okay. They're also moving into the ambulance space. Why? Because when you're deploying a fleet, you need to know so many parameters that humans can't take all the parameters into account to make the decision. What's the weather? How much gas is there in a truck? Is the truck how close is a shift of the person? So right now they're clocking to have 900,000 in purely recurring revenue, very high margins on that recurring revenue, and $2 million in AI services. So we're acquiring this. We need we'd spend $4.2 million to acquire. The new CEO who brought us the deal thinks he could 10x the revenues in 3 years. So I see we have quite a few questions here. We are very near term listing. Okay, I see people saying, "How can I get your shares?" We'll get to that very quickly. So we are finishing our listing round as we speak. We currently have a debenture out there. We are right now, the cap structure is at 50 million shares. 1/3 is owned by management who've invested heavily and will not be trading for 3 years. Patrick, do you want to speak about this?
Yeah, cap structure is pretty tight. Our shareholder base is really based on mostly from the Canadian point of view. A lot of investment banks, in fact, every major investment bank in Canada has a few of their people in it on a personal basis. They're excited about us going public or have committed numbers for the post-listing round, which is really going to be our heavy acquisition round through 2024. We have got a lockup within our acquisitions that we've done already. The ones that are coming on place are coming to place. So our exposed float would be somewhere north of 20, 25 million shares, which is a nice manageable position to have within the marketplace. Obviously options and so forth are sitting with management and high value hires for us. So fairly tight, fairly consistent group of investors. Patient investors, I would have to add, they're interested in the long play. They see the value in what the team brings to the AI space, which is really about understanding, getting through the pixie dust and really making good investment decisions based on performance and really what
So
extracting the value of transformative AI.
Well,
Thanks, Claude.
I see a few questions here. We'll try and address these. So what is our capital position? How you finance acquisitions? Well, one of the acquisitions is an all share deal, so that's going to be easy. We, as Patrick said, amongst our shareholders now, we have every representation from every investment bank. We have 5 banks now that are willing to fund $25 million after listing to go on an acquisition spree. And as you saw earlier, we want to acquire 20 companies. The goal is to acquire $100 million in AI revenue in the next 4 years. And if to give you an idea with that, the minimum multiple is 2.5. So we'd have roughly $250 million valuation with roughly 160 million outlying shares. Where can I buy your shares, Andre? So you can will write to us. We can buy right now in a very attractive debenture, priced at 20 cents, with full warrants at 25 cents, and 10% yield. What are your milestones for 2024? Can you speak to, again, the X factor you bring to portfolio companies? So milestones for 2024 is that we're listing in the fourth quarter of 2023. Upon that, we acquire these 2 companies very quickly. These are all set up, LOIs and SPAs. By the end of 2024, we should have around projected revenues of 11 million in revenues, $4 million in free flowing cash. We want to expand the deal flow pipeline from 1,000 companies to 4,000 companies, and go much more into the US. And I guess we have time for, that's it.
Sorry, Claude, we just missed one. We have a question that has been asked. Can you speak to the competitive environment to acquiring small revenue generating AI companies?
Well, the great thing here is that what we're bringing is the high growth that you would normally get that only accredited investors and even some big ones. Currently, all these companies, you can only participate in this high growth factor if you're an LP in a venture capital fund. We're actually bringing these deals to the public markets. We're allowing retail investors and institutional investors to have that high growth that most you only get normally from being in a VC. So we're acquiring them, with less risk. We're helping them grow. We have a network of over 150 people now within the company who are willing to work with us to help the companies grow. And then we also inject a little bit of cash upon acquisition to stabilize that growth. What you need to understand is that 20% year-over-year growth is horrible for a venture capital firm, right? That is stuff they want to get rid of. I think we're all in agreement here that in the public markets, 20% growth year-over-year is a massive success. So thank you very much.
Some of the factors. Sorry, Claude, just wanted to tail off that question if you don't mind. So part of the question was asking about the competitive nature. Like, who are we competing with when we buy companies? Claude?
Okay.
So
right now, we'll be competing with other major AI companies who are going to try and buy these smaller companies. Anyway, thank you very much.
Their ability to
if you have any further questions,
go ahead, Claude. Finish up.
Thank you very much. We're 2 minutes over our time. If you have any more questions, we'll be happy to respond to them and book a meeting with us in the next 2 days.